Hello, and welcome to the video series on building and defending budgets from the Finance Library. This is the third in a series of 3 videos on the topic. As you may recall from the other 2 videos, the topics we are covering in this series are, one, how CFOs think about money. This is part of the first video. Then we talked a little bit about how to structure a winning request, what needs to be in it, how to position it, and so on. And next, we also talked about how to make the case for high value but soft investments that lead to intangible benefits, which are not always easily measured in dollar terms. And so we talked about how to use dollar value proxies to be able to position and defend these kinds of hard to measure investments. In this third and last video, we're going to focus on understanding why in certain circumstances, even though when you have a good justification and a good project, you lose out and some of your competitor departments or competitor functions get funded and you do not. And also in this discussion, we will talk about coming up with a repeatable system that you can follow so that you get good at these budget processes. And every year you're not starting from scratch and you have a system that works. So we're going to start with trying to understand under what circumstances your competition may get their budgets approved and you don't. Okay? And the first thing to understand here is that the CFO and the finance organization more broadly has an important role as a portfolio manager. They are essentially not evaluating requests one by one in isolation, even with ranking. What they're doing is they're constructing a portfolio of bets across departments, across time horizons, and across risk profiles. The question they're trying to solve for isn't just about whether a particular proposal makes a good investment. Yes, that is part of the question, but it also asks the question, does this proposal fit the portfolio we are building right now? Okay. And when I say portfolio, essentially the investment direction can take 3 postures, if you will. So the first one is if the company is in a growth phase, the kinds of things that are emphasized, the kinds of strategies that are prioritized, the kind of activities that rise in importance are different in a growth phase, because in growth phase, the emphasis is on revenue generation, maximizing revenue. However, in a different circumstance, when the company, for whatever reason, is in a tightening phase, the circumstances are somewhat adverse, and the company is looking to reduce cost and manage its operational risk, that phase would take on a more of a belt tightening kind of orientation. And then, and under both circumstances, the finance organization always looks to align the choices with board priorities, and that would be done regardless of the phase and regardless of the individual merit of the case. If the board has very clear direction on what it hopes to achieve, then the decisions are made often to align with that preference. So In other words, the finance organization is focused on not judging a competition, but rather on building a portfolio. And so understanding the portfolio context before you submit your budget proposal is just as important as building a strong case for an individual investment. Okay. So with that background, you can I have tried to look at some of the reasons that I have seen as when a strong budget, an otherwise strong budget request fails. And and most of the time, the reasons have nothing to do with the quality of the individual project, and it has almost always a lot to do with the context within which that individual project is evaluated. So the kinds of things that I have observed, which cause an otherwise good proposal to be declined, are listed on this page. We'll go through them very quickly. So often what happens, and if you take the first one, is that the company has a priority in terms of when a particular investment should pay off. The horizons of decision making and value realization are, let's say it's short, let's say it's 12 to 18 months. If in that kind of an environment, you present an ROI and a payback period that is, let's say, 3 years. So even as strong as that project may be, because the immediate priority is on the 12 to 8 month horizon, this project gets turned down. Okay? So it has nothing to do with the quality of the project. It just has everything to do with the fact that at that point in time, the company's time horizon is 12 to 18 months, whereas this project was a 3-year project. In other cases, along the lines what we've discussed in the second video, what often happens is that there is a good argument being made, and the value proposition is well described, but not quantified and analyzed. So as much as the finance team may see value in it, they are not in a position to defend that investment upward. So in that case too, you can see what the challenge is. And so what you might do in those cases is, and let's assume it's a case where quantification is hard, do the best you can, run rough estimates, and fully recognizing that they are rough. And because even a limited analysis may give the finance team something to hang their hat on as they justify the allocation. Similarly, you may also see circumstances where the team used to thinking of themselves as a cost center frame the budget proposal in cost terms, not investment terms. So because the proposal is viewed as an operational expense and not a capital decision where there is a payoff to that investment, again, these kinds of proposals take lower priority. So it is important, like we saw in the second video, to lead with a return argument and not a cost argument. The fourth topic, which is more organizational rather than analytical, has to do with having a good executive sponsor. Often projects get submitted in isolation or without having an executive sponsor provide support visibly to the project. So when a proposal arrives on a standalone basis without context or without support, it is, it may be examined on the basis of its own merit. But if you had two projects, both roughly equivalent, one had executive sponsorship and the other did not, chances are that the project with the executive sponsorship will get accepted. Other kinds of things that I've seen is that the project gets late submitted late in the cycle, and it still may be a good project, but the fact is that the allocation process is a long one, and companies start informally allocating funds well before the submissions are received. So, which means that if the submission comes in late in the cycle, much of the decision making has already been done. So there may be limited room to make adjustments to be able to accept the proposal. So again, an otherwise good proposal gets rejected. So one of the ways you can overcome that is to start entering into conversations well before these submissions are due. And then finally, along the lines of what I just discussed a few minutes ago about the priorities of the firm, if you submit a project which is really solid, very valuable, but it happens to be misaligned with the portfolio thesis of the company at that point in time. So if it doesn't fit the strategic priorities uh, at the time when the proposal is being submitted, you may end up with a rejection of a good quality proposal. And again, like in the case of the of cultivating and developing, starting conversations early, it's important to make sure that you understand the business priorities that are top of mind to leadership around the time these decisions are being made, so that you can position and align your proposals to those business priorities. So now, some of these you may have more control over and others less so. But if I have to pick the two most easily fixed failure kind of issues, uh, the first is timing. It's less about the analytics, more about uh, kind of understanding the process and positioning yourself well. Um, And timing here is super important, because if you know well in advance where the finance team is going, what their priorities are, you have floated a trial balloon early enough so that they have a sense of what we are coming up with, and you can have early insight into whether that is going to be well received or not, and what tweaks you can make to make sure that it is best received. Those are all super important. So if you're not in that conversation early, you may believe that you are putting together a very powerful proposal, when in fact um, the circumstances are not right and you are walking in blind. The second you can do, again, unrelated to analytics and the strength of the case by itself, is the importance of sponsorship. Sponsorship from a senior executive, uh, from functions that may benefit from what you do, buy-in from various other parts of the organization. These are important because, yes, there is a certain level of persuasion that comes from having multiple people speak about it. But more importantly, the finance organization will see the support that your proposal is receiving from various parts of the organization, and take it as a signal that this idea has been stress tested and there are multiple parties interested in having uh, um, this move forward. Multiple parties who think that the investment is worth it. And that kind of a signal is often way more valuable than several additional layers of analysis that you might perform. So those are some of the things that are often well within your reach, and strategies that you can relatively easily adopt. But if we were to take a step back and think about how you might act, in the longer term, um, how you might act more broadly so that you don't end up having to be in a position to have to deal with these circumstances. There are a few things you can do, and one of the things I would strongly recommend is to think about the three questions I have listed on this page before finalizing any budget request. By thinking about these questions and trying to find the answers to those, hopefully you will understand the context of your proposal well enough to position it powerfully. These questions, like we have kind of alluded to before, is A, what is the business's current strategic priority? Knowing that helps you align your proposal to that. And the board communications, the CEO letters, all hands decks, annual plans, public filings if the company is public are all good sources of information about the current strategic priorities of the firm. The second thing you might want to understand, and it's related to the first, is about whether the firm is in a growth or a preservation posture. Now, chances are that you know this already, but often these kinds of priorities evolve. Then sometimes there is the officially stated version and what's happening in the background or what's happening one layer below that. So, having finance partner conversations, uh, you know, tracking earnings commentary, budget guidance memos are all good sources of information for understanding what the firm's current risk posture might be. And then finally, if you know of a department that has consistently been successful in negotiating the budgets it needs, it is helpful to have the peer conversations or trying to understand what they did, what other successful groups did, talk to the finance department to see if there are any patterns they recognize or you could recognize to position yourself better to improve the odds of your proposals getting approved. So far we have talked about the various strategies you might adopt. But like I said a minute ago, it is helpful also to think about the process that you might implement so that you have a repeatable system that you can utilize year after year. If you look at executives who have mastered the budget process, and what I have seen is they recognize early that the formal budget submission process it represents only the last 20 or 30% of the work that needs to be submitted for the proposal, 30% of the work that's needed to create the proposal that needs to be submitted. The other 70 to 80% happens well before it, right? Along the, again, understanding from the finance department what where the firm is heading, reviewing documents, board documents, or management reports that talk about the firm's priorities. All of that is very valuable information, and having that valuable information well before you sit down to put your proposal together can be quite helpful. So what I've tried to do is I've tried to mirror this process that I've seen from successful executives employ and converted that into a 90-day budget readiness plan. Okay? And I've tried to present it here. The 90-day cover 3 distinct phases, each requiring different work and different conversations. And the 3 phases roughly correspond to about a month or so. Okay? So there are 3 phases. The first one is know your numbers. The second one is build your case. And the third is building alignment. So let's look at each of those components. What do I mean by knowing your numbers? The first thing to do is look at your function's budget experience. Audit the prior year spend versus the budget you submitted. Look at it for a few years. Try and understand where the variance happened, why it happened, and whether the issue was was because the budget was well done, but the circumstances changed, or the budget was poorly prepared, and as a result, it was hard to deliver on that budget expectations. Go back to prior projects and look at the expected versus actual ROI on projects that were previously approved. Um, you know, look at, for instance, your top 3 investment priorities and map it to the priorities of the organization, and then distill all of that into a few well-built proposals to be embedded in your budget submission rather than submit, a half a dozen or dozen such requests, right? So keeping it simple, clean, and well aligned with uh, the firm's priorities is more easily done when you know your numbers. Once you have that background, um, you use the second month to start building your case. One of the things you may do is using the 5-part structure that we discussed in the second video, you start creating a document which outlines the need, the ROI, the business case, the fully loaded costs, the returns, and so on. And you do all those calculations and um, to create a first draft, run the ROI, payback, and NPV calculations if necessary, get buy-in on the methodology from the finance folks, double check the numbers, make sure you're comfortable with it. Look for opportunities to monetize and quantify the benefits of soft investments that you may not have previously captured. Again, use this time to make sure that you have the right proxies, ask the various teams for input, and make sure that you have you stress test the assumptions and look for build sensitivity ranges so that you know that even if you get pushed back on 1 or 2 assumptions, your proposal will be able to withstand that scrutiny and will not get dismissed because you had not done your homework. One classic kind of question you may want to ask in this context is, what does the case look like at half your estimated return, right? If things don't go out to plan and the benefits realized are half what you expected, is there still a case to be made? If there is a case to be made, even at when half the benefits are realized, you have a strong and robust case. If you find that the results are highly sensitive to assumptions, that's something you may need to think about in the second month as you figure out how to position your proposals. Month 3 is all relational. You use this time to have informal conversations with people well before the formal process opens. Clearly, your finance business partners are a good source of information. Using them as a sounding board can be very powerful. Same with executive sponsors and the other beneficiaries. So, for instance, if you're building a new IT system which makes a certain process efficient, anybody and everybody who benefits from that change are good allies to build a relationship with. And so what happens as a result then is that by the time your formal submission arrives, it would not be the first time that the finance team is seeing your ideas. They would have seen draft versions of it. They would have seen how assumptions have been firmed up. They would have seen the evolution of the project, of the proposal. And so your submission becomes a summary of the conversations they've already had. Okay? And then if you want to take it one step further and to build credibility over time, you can also commit to and or have regular touch points with the finance team to show them how your proposals are actually playing out, even when they are not playing out perfectly or they're playing out in a way that is not exactly the way you planned. By having these conversations with the finance team, you often can find workarounds And it also helps the finance organization because that prevents them from having large surprises at the end of the year, which makes their life hard and causes them to lose confidence in your ability to manage your budget. Okay? So that brings us to the end of this video series. And just to recap, what we have done here is to look at 5 broad topics. First, we tried to understand how CFOs think, because that would help us structure our proposals in a way that's aligned with the finance team's priorities and preferences. Then we talked about how to structure those requests, what to have, how much to put in, what kinds of things to have in these proposals, and so on. Then we switched gears and looked at the certain kinds of investments where the payoffs are intangible and hard to quantify, and what can be done in those circumstances to provide a quantitative number, which then enables the finance team to have a basis for pushing the case forward. We also talked about navigating the organization, building relationships within the finance team, having executive and other buy-in from the firm so that your proposal looks strong and comfortable by the time it reaches the finance team. And then, broadly speaking, how to build a repeatable system that you can deploy year after year to successfully navigate and negotiate your budget needs. And I will admit that the budget season is hard for executives because you are being forced to talk a language that none of you were taught, right? But I think with these discussions, hopefully you have a better sense of the role of the CFO, how they are more an allocator of capital, and how, if you understand their metrics and frameworks, you are in a better position to make the value you create visible in a language which is familiar to the people who control capital. And as a result, you feel more equipped to engage in budget discussions more effectively. Hope you found the discussion useful. Do feel free to reach out if you have any questions. I hope you will check out the other content we have on related topics on both the website and YouTube. Thanks for your time and take care. See you soon.